It's the year 1907 and the U.S. economy is a disaster waiting to happen. Banks are stressed to their limits as credit tightens. The economy is still reeling from the aftermath of the 1906 San Francisco earthquake. People are just trying to get back to normal. But in the background, two opportunistic men are circling like wolves smelling blood. They can see that the slightest push could send everything crashing down, and they intend to deliver that push. These two men, Augustus Hines and Charles W. Morse, will go down in history as some of the most ruthless schemers of all time. And if it wasn't for one fateful error, their names might be completely forgotten today. Hi, everyone. Today, we're going to look at how these two masterminds planned to break the U.S. economy and what went wrong for them. If you enjoy stories like this, please consider subscribing. It really helps me out. Part 1. The Fragile Setting. We first meet our protagonist, Augustus Hines, in the early 1890s in Montana. Here, he earned the nickname the Copper King due to his extremely ruthless business practices around mining claims. He made many enemies during this time, including the extremely powerful Amalgamated Copper monopoly. In his war against them, he launched dozens of lawsuits which only succeeded in making him even more unpopular with other businessmen. His antics got so bad that he even started digging underground tunnels under rival mines to literally steal their high-grade ore. His competitors were outraged, but there was nothing they could do about it. This guy was a real piece of work. However, in 1899, Hines was forced to sell out and abandon his dreams of copper domination after Amalgamated Copper won a lawsuit against him. He fled to New York and changed his focus to finance, seeing a new opportunity to make big money. Coincidentally, there was already an established stock market bubble in copper at the time. Unfortunately, this was also the time when Morse entered the picture. Charles W. Morse built his fortune in the early 1890s through the American Ice Company empire. The company controlled nearly the entire ice supply in the U.S. at the time, and he gained this control through underhanded tactics like bribery, deception, and straight-up fraud. However, by 1899, Morse wanted to expand and grow beyond ice. So he began moving into the finance world. He started buying up small neighborhood banks, controlling them from the inside, and using their deposits to fuel further expansion. At the core of his financial empire sat Knickerbocker Trust Company. It was a prestigious and lightly regulated bank on Wall Street, and its customers trusted Morse implicitly. At this point, our story begins to take shape. Hines and Morse had both climbed to the top of their respective food chains, but they both still needed something that only each other could provide. Hines needed a bank to finance his future schemes, and Morse needed someone who could show him the secrets of stock market manipulation. After meeting, they quickly came to an understanding and joined forces. Morse gave Hines access to the cash he needed, while Hines opened the world of stock market manipulation to Morse. Together, they would have an explosive impact on Wall Street. In fact, their first project together was so daring that it would go down in history as the largest speculative gamble ever taken up until that point. Their plan involved a group of stocks known as United Copper Company. At the beginning of 1907, the stock price was trading for around $60 per share. The plan, which was devised by Hines's brother Otto, was called the short squeeze. It worked like this. You buy as much of the stock as you possibly can, then you announce to the public that you're going to be doing a hostile takeover. Immediately, every other investor scrambles to buy up the remaining stock because they don't want to be left holding the bag. This causes the price to skyrocket. Then the people who initiated the squeeze sell all their stock for a huge profit. Theoretically, this could make them a lot of money. But here's where things start to go off the rails. You see, the United Copper Company was a subsidiary of Morse's personal bank, so he could manipulate the price however he wanted. In fact, he was the one who decided how much of the stock to print in the first place. But Morse and Hines were greedy and wanted to take things even further. They wanted to use this leverage to not only make a ton of money themselves, but to bring the entire U.S. economy crashing down with them. To accomplish this, they would need a lot of money, and that's where Knickerbocker Trust came in. Using the bank's assets, they took out a huge loan in order to purchase tens of thousands of shares of stock. As expected, the price immediately shot up after the announcement. But there was a problem. They had hoped that the price would increase by around 200%, but it only went up by 100%. To make matters worse, they couldn't find enough stock to buy. They simply couldn't corner the market like they had planned. Now, this shouldn't have been a big deal. After all, the price was still up 100% and they were sitting on a huge pile of cash. But this is where greed takes over. Hines wanted to ride the wave all the way to the top, even though his initial goal had already been met. He refused to sell and began waiting for an even bigger jump in price. But, unfortunately, the price never went up again. In fact, it started to slowly come back down. On October 15, 1907, the whole thing fell apart. Hines and Morse sold all their stock at a loss, and in doing so, destroyed any confidence left in United Copper. What followed was the collapse of Knickerbocker Trust. On October 22nd, hundreds of people showed up at the bank demanding their money. The tellers didn't have enough cash on hand to pay everyone, but they did manage to pay out millions before the doors were slammed shut. This triggered a panic throughout the city, and the bank run continued for days. By the end of the ordeal, Morse had lost everything. But interestingly enough, Hines managed to escape with a couple $1 million in his pocket. Now, the moral of this story is pretty obvious. Greed always finds a way to destroy itself. But it doesn't have to end here. We'll pick up right where we left off and look at the aftermath of the bank run. We'll follow the trail as it leads us to J.P. Morgan and the Federal Reserve. And trust me when I say things get a little crazy. There's even a secret third mastermind that no one knew about until recently. It's actually insane. He's also a liar, a fraudster, a manipulator, and an outright criminal. In fact, he would make the perfect protagonist for one of our videos. By the start of the 20th century, Barney had been working for years as a broker at the Knickerbocker Trust Company in New York. At the time, trust companies were basically like investment banks, helping corporations raise capital. But these companies were also quite loosely regulated and prone to corruption. Barney had already made a name for himself as the king of shady real estate deals, but now he wants more. So he hatches a plan to defraud Knickerbocker for millions of dollars. Now, it's important to know how money worked back then because it's a little different than today. First, there were two types of currency in circulation. You had gold and silver coins, which were backed by the government, and then you had paper money issued by individual banks, which were not backed by any physical commodity. Paper money was therefore only as good as the bank that issued it. If they went bankrupt, those papers became worthless. Second, the government did not have a central bank like we do today. There was no Federal Reserve, no FDIC, nothing. Banks were expected to be self-regulating, and if one went bankrupt, well, that was just tough luck because back then there were absolutely no consequences for messing up your banking system. So here's what Barney does. He convinces Knickerbocker to buy $10 million worth of delinquent mortgage loans from him and to pay him in non-recallable 6% bonds. Now remember that at the time, banks issued their own type of paper money. So when Knickerbocker pays Barney with these 6% bonds, they get recorded on the bank's books as an asset. Then Barney goes and sells these very same bonds to other people for face value and pockets the difference. Basically, he took something worth $10 million, sold it twice, once for 11, and then again for 12, and pocketed the profit. He repeats this several times over and over, and soon he has defrauded Knickerbocker for a total of $25 million. The problem is that Barney is not very good at hiding his tracks, and Knickerbocker eventually finds out that they've been robbed. Now, panicking, Barney tries to flee to Europe, but before he can leave, he is arrested and charged with embezzlement. It seems like an open and shut case, but Barney is a master manipulator and he manages to convince Knickerbocker not to press charges against him. Instead, he offers them a deal. He'll tell them where he stashed some of the loot, and in exchange, they drop the charges. Knickerbocker takes the deal, but within weeks, Barney has disappeared with the money and the authorities are forced to reopen the case. It looks like the ordeal is over for Knickerbocker, But it actually is just beginning, because all of the banks that Barney has been dealing with, including Knickerbocker, all have one thing in common. They have almost no cash on hand. Back then, banks would keep very little cash in reserve and instead invest most of their customers' deposits into long-term securities. Because of this, when news broke about Knickerbocker's collapse, people started withdrawing their money, but the bank simply didn't have any cash. Soon, lines of customers were waiting outside the doors of Knickerbocker demanding their money back. When the bank couldn't comply, panic ensued. People started running to the bank to withdraw their cash, but this only accelerated the bank's downfall and made it impossible for them to ever reopen. As the crisis spiraled out of control, people started losing faith in the entire American financial system. To make matters worse, the New York Stock Exchange began losing nearly half of its value. Investors were panicking, the stock market was crashing, and people were running out of their banks. So, who was going to save the economy? Enter J.P. Morgan. Now, if you're not familiar with J.P. Morgan, just know that he was the most powerful banker in the world. He was so rich and influential that when he entered a room, everyone else in the room was considered secondary. When the Knickerbocker crisis first broke out, he was vacationing in Europe, but immediately cut his trip short and returned to New York. On September 25, 1907, he held an emergency meeting in his private library. The door was locked and nobody was admitted except for 6 of the most powerful bankers in the country. For 3 days straight, they worked around the clock to come up with a solution. Eventually, they decided that the best option was to prop up Knickerbocker and restore confidence in the stock market. And so J.P. Morgan got to work. Using his vast influence and connections, he raised $50 million to bail out the Trust Company of America. And then he turned his attention to the stock market. Using his own money, he bought up tens of millions of dollars worth of stocks, driving up the price and convincing investors that everything was fine. Everyone else was losing their minds, but J.P. Morgan was calm and cool and collected. He understood the gravity of the situation and knew that he needed to act fast. And, thanks to his efforts, the panic slowly came to a halt. But not everyone walked away unscathed. Barney, of course, was the first to go. Despite striking a deal with Knickerbocker, he never gave them the full amount that he owed them. Instead, he gambled it all away at the roulette table and soon found himself destitute. Unable to cope with his failures, he drank himself to death. Then there was Morse, the owner of Knickerbocker. He refused to accept responsibility for the collapse of his company and tried to pin the blame on someone else. He was later convicted of bank embezzlement and sentenced to 4 years in prison. It was there that he met an old friend, the infamous Carlo Ponzi. Finally, there was Barney, the mastermind behind it all. After being exposed, he attempted to flee the country, but was caught and brought back to face trial. He was so ashamed for what he had done that he ended up taking his own life. The panic of 1907 may not have resulted in a depression, but it sure as hell taught us a valuable lesson. The U.S. financial system was too important to be left to the banks alone. A single bank run could take down the entire economy. In response, the U.S. government passed legislation creating the Federal Reserve System, which officially opened for business in 1913. Thanks for watching.